If you're in deferment and forbearance, what I'm about to share with you over the next 2 to 3 minutes is critical and crucial and will save you thousands of dollars. I mean, if you have hundreds of thousands of dollars in student loans, it could save you tens of thousands of dollars. So stay tuned for the next 2 to 3 minutes. I know sometimes listening to finances isn't the most fun, but I'll try to make it as fun as possible. My name is Zack Geist. I'm talking real fast to squeeze it in that 2 to 3 minutes. And I'm the student loan tutor. Deferment and forbearance, the reason that these typically existed is for financial hardship or when people first get out of school. You've got deferment, which allows you to not pay your loans, and the government will cover the subsidized portion of your loan. So there's two types of a federal student loan, right? You've got subsidized and unsubsidized. Subsidized is exactly what it sounds like. It means the interest is paid for by the government. So when you're in deferment, the subsidized portion of the interest is not accruing. However, the unsubsidized portion is accruing and is capitalizing, which I'll get to in a minute what capitalization means. Now, if you're in forbearance, which most people run out of deferment, and what do? They go into forbearance. When they go into forbearance, the subsidized and the unsubsidized portions of your student loan both accumulate interest, and at the same time it capitalizes, which leads me to what is capitalization. Capitalization works in a funny way. Essentially what capitalization is it's interest accruing more interest. So you've got a balance of, let's say, $100. The $100 is accruing, I'm going to throw some real rough numbers out here. If you pull your calculator, I'm going to be wrong because it'd be a really boring video if I did it in exact numbers. But just picture for a second, you've got $100 and it's 10% interest. If that accumulates over the year and it doesn't capitalize, you're just going to pay 10% on that $100. What's happening with this is that at the end of every day, it's calculated however many days are in the month and how much interest accrued that day. And then maybe it's $1, for example. It's not, but let's say it was. It would add to that, and now that $101 is accruing interest. The next day, $102. Next day, so now you're gaining interest upon interest. And that's how you see those, those memes that are maybe not so funny, where you've got like a 70-year-old woman holding a sign that says, when I graduated from college, 40 years ago, I had $20,000 in student loan debt. Now I've got $480,000 or whatever it is. The reason that happens is that magical thing called capitalizing interest. When that happens is when you're not covering at least your interest payment on your loans. I say all this to say, don't go into deferment and forbearance. If you're in deferment or forbearance, you need to call us. Why? Because you obviously don't understand, and I'm not saying this to be offensive, but you don't understand how income-driven repayment works. And you might have heard of income contingent or income-based repayment. There's 5 different income-driven repayment options that all work differently. And depending on what your situation is, there's ways you could take advantage of one more than another. Now, let me tell you the advantages of income-driven repayment. One of the major advantages of income-driven repayment is that your interest doesn't capitalize. So whatever interest is accumulating is not growing on top of itself. So you're only accumulating the interest on the original principal balance of the loan. And if you call us, of course, I'll explain that in a more easy way. I don't know what level everybody that's watching this is on. There's also a new income-driven repayment that just came out December 16th, 2015, revised pay-as-you-earn, that qualifies for 50% negative amortization interest forgiveness at the end of each month. Now you might go, what in the heck is negative amortization interest forgiveness, and why is it 50% of it, and how does that even happen? Student loans, the way that they work with income-driven repayment, defies all logic. The people that I have the most difficult time explaining how these loans work to are people that work in loans, because they go, well, that doesn't make any sense. Like, why is the government getting rid of the interest? Like where does the interest go? And what happens to the balance at the end of 25 years? It's going to be this gigantic balance. What? It's forgiven? But if it's forgiven, how does that work? I'm telling you, if you're in deferment or in forbearance, give us a call. Let me break this all down to you. If you're not talking to me, you'll be talking to one of my professionals. Everybody that you're going to speak to is either an attorney, a doctor, a surgeon, chiropractor. Most of our employees used to be clients of ours, so they'll probably be a lot like you. Heck, you never know. Maybe we'll even hire you on the team here. So I look forward to speaking with you. Click the button to talk to us. My name is Zack Geist, and I'm the student loan tutor, signing out.